So yeah, we're gonna go through how to find a precise entry. So the very first page, again, this doesn't really matter. Let's go to here. So we're gonna go through this checklist real quick. And it's kind of a 3-step confluence, and I'm gonna add some other parts into it, and then we're gonna go into the charts to get some more in-depth. I'll give you some real examples of A+ setups compared to not as good of entries. So the very first thing that we want to look at is our higher time frame market structure and bias, right? And how do we do that? Well, we go through and we identify, first of all, premium and discount of our range, right? So the top 50% of our range and the bottom 50%. We want to look for our hourly, our 4-hour, our daily, and our weekly fair value gaps or order blocks. I tend to look at fair value gaps more than I do order blocks in my trading, but you can look at both of them. And the reason this is important is because you want to see delivery from a higher time frame PD array when you're getting into a trade. Most of the time, if you try to take a trade and we're not delivering from a fair value gap on the higher time frame, it's probably not going to be a good trade. It's probably going to be a lower probability setup. All right, the next thing on step 1, how do we find our market structure and bias? Well, we got to find where our key liquidity zones are, right? So how do we find key liquidity? We're looking at Asia highs and lows, London highs and lows, previous day highs and lows, previous week highs and lows, right? Those are going to be the main things we want to look at. And then we can go down further into our charts and we can chart out our 4-hour highs and lows, our 1-hour highs and lows, right? We want to have our external liquidity all charted out. So that's going to be our swing highs and swing lows on our higher time frames. So obviously, I'll go back to the charts in a second. But the next thing, the last part of step 1 is determine what kind of market we have. Are we accumulating, moving sideways like today? Are we manipulating, going to manipulate and grab liquidity? Or are we distributing, right? I typically like to focus on the distribution or the expansion moves because that's typically when we find the best trades with the most reward. So just going off of that very first step in our confluence checklist, right? Let's go back to the charts and let's find an example of delivery from a higher time frame fair value gap, right? So we can kind of go back and let's try to find a good example. I kind of want to go back to this weekly fair value gap that we had up here. So let's say going into the week, we want to see us deliver from a weekly bearish fair value gap. Well, right here we have the weekly fair value gap, right? Because we have this wick here, we have this gap, we have this wick here, leaving us that FEG. Okay, perfect. So this is going to be our weekly CIBI. So we see price trade into that level. Now, do we see where price reacts off of? Perfectly right around that 50%, that touch point, consequent encroachment of that fair value gap. So after we see price is reacting off that 50% and we are getting delivery to sell side, that is now how we kind of know, all right, we have clear bias. We have clear understanding that price wants to move lower because on the weekly time frame, we're seeing a super strong reaction out of that weekly bearish fair value gap, right? So the other thing you can look at is market structure in general. How did I know we were going to continue bearish once we close below this swing low right here? So that gives us our market structure shift on a weekly time frame. Boom. That is going to be our MSS, market structure shift. Okay, so we get a clean close below. We create a fair value gap. So now I know on our higher time frames, we are looking extremely bearish. We also throw in the fundamentals, right? We knew we were looking more bearish because of the tariffs and everything, but still, on technical analysis, it looked really bearish as well. And what else do we have? We have sell-side liquidity resting below on the weekly time frame at swing lows. Okay, so now we've pretty much just crossed off everything we need to know that we have a bearish bias going into the week, and then we could even drop it down, right? And again, I called out this exact week, everything that would happen, right? I said Monday, Tuesday, we're going to be bullish. We're going to trade into the weekly fair value gap. What did we do? We trade into the weekly. What else do we have up here? Well, we have a daily bearish order block with these 2 up-close candles. That's another confluence for bearish structure, okay? We react off the order block, the weekly fair value gap, and now I'm expecting a Wednesday reversal, so this is the day that we want to be looking for expansion on that Wednesday candle. Okay, so we knew our bias was bearish going into that day, so we just need to see price react off that weekly CIBI. Once it reacts, that's when we're looking for our trade setup, right? And then where are we looking to target? Well, first of all, if we got entries all the way up here, we're looking to target previous day low. Remember, we're looking at previous session liquidity because just having a bias is not enough. We need to know where price is actually going. Where is it targeting? Where are key levels? Well, we have previous day low here. And then we could even go back to the weekly time frame and we could look at our previous week low. Okay, that's going to be another level that we want to see price grab. So there's our previous week low. Boom. So now we have previous day low, previous week low, obvious sell side targets for the week. And even Monday low, that's another sell side target. So that's kind of the first step, right? We are determining our higher time frame bias. We're determining our drawn liquidity. And if we are delivering from a higher time frame fair value gap. If you do not see us delivering from an hourly, a 4-hour, a daily, or a weekly fair value gap, then it is probably the best idea to not take a trade during that session, right? Because we're probably not going to see follow through. More than likely, we're not going to see expansion. Okay, so that's step number 1. Now we need to move down to step number 2, right? We got to look for high probability areas, right? And I talked about that a little bit already, but fair value gaps, order blocks, liquidity zones, okay? So we want to make sure that our entries are in these levels. We don't want to just be taking entries in the middle of a range when we don't have a fair value gap, we don't have an order block, we don't even have liquidity to target or anything like that, right? So I put right here, point of interest, right? This is where smart money engages. This is where the institutions, the market makers are making big moves. Another thing that we could throw into there is trading during the macros, the last 10 minutes of every hour and the first 10 minutes of every hour, because that's typically when the institutions are really putting volume into the market. They're putting bigger orders, and we see the market moving better. Okay, so that's step number 2. Step number 3, lower time frame confirmation. Now this goes to our entry models, right? This is when we want to drop down to the 1 minute, the 5 minute, and the 15 minute to find more refined entries and more precise entries, like I was saying, right? So we need to make sure that our entry models are aligning with our higher time frame draw on liquidity and bias. Okay, so that's when we're looking at liquidity sweeps. That's when we're looking at break of structure, market structure shift for our confirmations, right? We're looking at IFEGs. That's when we're kind of going down to our lower time frames, right? So let's just say, I'm going to use the rewind tool real quick so we can just go back to this exact day and see if we find any entries on our lower time frames. All right, so this is going to be going into Wednesday, right? We have Wednesday open up here. And then we see that price starts delivering from the weekly fair value gap really, really good. Well, we typically don't want to trade. I'm typically not trading until market open. So that's when we're kind of going down to the 15-minute time frame at market open. That's when we're charting out our opening range, right? So this is our first 15-minute candle. Boom, right here. Now we have our 15-minute opening range low, and then we have our 15-minute opening range high. So we know we're delivering from a weekly fair value gap. We know we have sell-side liquidity below. Right, we have our previous day low target. Boom, look at that perfect swing low right there for price to target. Right, so now we have our 15-minute opening range. Let's grab this. Let's go all the way back to here. All right, so 15-minute opening range. Let's now go to the 1 minute time frame. Let's see if the 1 minute time frame sets up any entry models, right? Because this is now when we dial in our setups. We have our bias, we have our draw on liquidity, we have our, if we go down here, remember our key entry zones. We see that we are setting up our 15-minute opening range. We're going into our macro. So everything is lining up. So I'm just going to press play real quick and let's see how this kind of plays out here. Okay, boom. Look at that. Quick close below our opening range. Now, we might not even get an entry model on this because of how aggressive this moved down, right? So what does that typically mean? Well, you might have to stay out of the market if you don't see an entry model, right? Because, again, on this move, we did create a 1 minute busy. So this would be the first level I'd want to take an entry off of because we inverse that 1 minute IFEG, right? Or that 1 minute busy. But notice how we don't close below and then we close below all the way down here, about 60 to 70 ticks away. So we're not really given that opportunity for an entry yet. So on a move like this, when it's this aggressive, this would be a time where sometimes I would honestly just take a super aggressive entry once we close below that opening range. Recently, I'm not doing that because of how crazy our market is. You asked me that 3 months ago, I probably would have taken that opening range breakout. But let's just play it out, right? So typically, when I see something like this, I would want to see a retest of that IFEG, or I'd want to see us come back up and trade into a 1 minute bearish fair value gap like we formed right here after getting that close below. So let's click play again, and we can see how aggressive this moves down, right? This is just absolutely dumping. This one did not really offer us any entry models. But the point of the, of this trade or of this concept is that we saw delivery from a higher time frame imbalance. We have a clear drawn liquidity at previous day low. We have very strong bearish market structure, so everything looks bearish. And the last step would just be looking for an entry model. And if you don't have the entry model, then you should not be taking a trade, right? So this is an example of something you might need to stay out of. If you don't, unless you want to be super aggressive right here, take the entry right as we're breaking through, you probably should stay out of this because you don't have your entry model, right? Unless you wanted to keep your stop above, maybe have a bigger stop loss, take the aggressive entry, target that previous day low. That's one thing, right? But remember, if you don't have the entry model, the third step, then you should not be taking a trade, because who's to say that price wouldn't just run back up to that IFEG and stop you out? We don't really know if it's going to do that or not, right? So if you go against your strategy and you don't take a trade with an entry model, the likelihood of you getting stopped out is way higher. So I would always rather miss out on this trade, and not because I don't have an entry model. Who cares? If I miss out on that trade, oh well. But what if I did try to take that trade and then price runs right back on me like this and it stops me out, before making the move down, and now I'm sitting on the sideline wondering why I went against my plan, right? So that is a huge part of taking precise entries. You're never going to have precise entries if you're going against your entry models, if you're not taking trades with your entry models, right? So we can keep playing this out, kind of see where it goes. Now we're making lows. Now we're kind of chopping. And we finally take that previous day low, right? So on this example, again, I don't remember if I traded this day or not. I really don't remember, but I think I did at some point. But this is probably not a trade that I would take, right? Because it doesn't have my entry model. So that's just one example of seeing delivery from a higher time frame for value gap, having obvious sell side liquidity, but the third step does not get met, so we don't take the trade. Okay, we can go look at another example, or you know what? Let's go back to the HVCO here. Let's go back to this PDF and kind of look through. So, step number 2, right? We kind of got to go to the next page here. Entry triggers and timing, right? When do you actually want to take the trade? Well, this is when we really dive deep into our entry models. So there's a few different entry models that you guys will see me use on a regular basis. Now, obviously, the main two that I'm always going to use are the GUI model and the 15-minute orb. And if you are new here and you don't know what those strategies are, you need to go watch my YouTube on both of those strategies to get familiar with it. Other entries I'll use are breaker blocks and unicorn models. You guys know I really like those. Silver bullet hour is another high probability time to take trades, right? 10 to 11 a.m. Eastern, 2 to 3 p.m. Eastern. Those are going to be times where I really like to take entries, right? Where we're using fair value gaps on the 1 through the 5 minute to take entries. And then obviously the GUI model down here, which again, I encourage you guys to go watch that. But this is just letting you guys know that these are some of the main entry models that we want to be looking for to take our trades. And if you don't see the entry models like these ones, then why are you taking the trade, right? So we want to be using the 1 and the 5 minute for the most part to take take our entries. I typically take my entries on the 1 minute time frame for the most part. We want to be getting confirmation and confluence, right? And that's when we throw things in like SMT divergence. That's when we look at the VIX. We're looking at break of structure. We're looking at IFEGs, right? All of these things are going to give us more insight on our actual entry compared to just jumping in when we have one confluence, right? Let's just say you're like, okay, we're delivering from a weekly fair value gap up here. And, we have a 1 minute fair value gap. So I'm just going to jump into a trade. And go back here. All right, so let's go back to that level. I need to rewind a little bit here. So let's just say you're up here, you're looking for a trade, and you don't have an entry model, and you're like, you know what? If I just see a 1 minute fair value gap, I'm jumping into an entry. Is that a high probability setup, guys? No, it's not high probability. Because is it during silver bullet hour? Did we get a liquidity sweep? Do you have a reason for taking a 1 minute fair value gap entry? Right? Again, it just goes back to that idea of having multiple confluences, right? Let's say it's during silver bullet hour. Let's say we hit 10 a.m. So let's press play real quick. Okay, so we're going into 10 a.m. All right, so 10 a.m. is happening. So now we know we have a very aggressive move down. We still have sell side liquidity. Now I would be like, okay, well, maybe I'd look for a 1 minute fair value gap entry because we're in silver bullet, and I would take it down to sell side, right? Now, where's our first fair value gap? Well, we have one here, we have one here. This is not a high probability setup still, because look how low we are. Remember, back to the premium discount. We're looking at our previous day range. This is previous day low here. Our previous day high was all the way up above, right? We're in the complete discount of our previous day range, so that's probably not a trade I'm going to take. That's another thing that's really important when it comes to precision entries is the lowest probability setups that you can take are when you wait for the trade to fully happen for the whole expansion, and then you take a trade at the very bottom, trying to just hope that it continues in your direction when there's only about 50 more ticks of profit, right? Or reward that we're expecting. So you don't want to be looking for the trade all the way down here. Stop waiting for the move to happen and then taking your trade once the move's already done. That's when you get stopped out on those big retracement moves, right, that come back up. And it's just not fun. That's not where we want to take our entries. We want to be in at the top of the move or the bottom of the move if it's a bullish trade, right? You don't want to be chasing all the way down here. You don't want to be chasing all the way up here. You want to get in the shorts from up here. You want to get in the longs from down here the best you can, right? And that's why using IFEGs is so important. That's why looking for liquidity sweeps is so important. And that's why delivery from fair value gaps on the higher time frame is the most important, right? Because you can time your entries better if you know we're delivering from a weekly fair value gap, right? You can get in near the top of the move going into market open if you see your entry model. Compared to, let's just say you didn't even know we had a weekly fair value gap, and you're just kind of looking for a trade up here, and you're like, you know what, we look kind of long right now. We got a break of structure to the upside. I'm going to jump into a bullish fair value gap right here. Well, you have no understanding of our overall market structure. You're just purely trying to jump into a trade off of a 1 minute bullish fair value gap right here, but you don't understand that we're delivering from a higher time frame fair value gap, right? So stop trying to take just every fair value gap entry you see and start using these different confluences to have more precise entries. Okay, and then kind of the last, step here is your stop loss and risk management, right? This is maybe the most important thing of this entire lesson. All right, where to put your stop losses, how to manage your risk. Well, typically I am targeting a 1 to 2 RR on most of my trades. That's kind of the minimum that I look for, right? So that means if I have a 50% win rate, I'm going to be around break even. Or I'm still going to be, wait, what does that mean? If I'm 1 to 2? Yeah. Okay. So let's say I have a 50% win rate, I'm going to be still making profit, right? Now let's say I targeted a 1 to 1 all the time and I, have a 50% win rate, I'm going to be break even. So I'm typically targeting a 1 to 2 RR on most of my trades. And a lot of my trades are going to be 1 to 3, 1 to 4, 1 to 5 if we get precise entries like I was talking about, right? So what we want to do is the best places to have our stop losses on trades are above the wicks on our fair value gap candles, above the wicks on our order block candles, above or below swing lows and swing highs. Those are typically the best. You can also look at the equilibrium of a fair value gap sometimes, or of an order block to keep your stop loss just above the equilibrium, but that's not as good of a stop loss. I like to keep them above or below my fair value gaps and my order blocks, right? So let's go to position sizing, right? If you have a small stop loss, then you can have a larger position size, and vice versa. If you have a huge stop loss, you need to scale down on your position, like I have this past 2 weeks, right? I'm trading micros now because I understand my stop losses have to be at least 100 plus ticks on every single trade I take. So now I'm not trading heavy, I'm trading light, because if I have to have 150 tick stop loss, that means that my reward at least has to be 300 ticks. So I'm still looking for really good profit on these moves, but I'm not going to be risking 4 minis with a 150 tick stop loss, right? That's not something I'm going to do. So just keep that in mind when we're in higher volatility times. It's probably better to size down, keeping larger stop losses, right? And then you need to keep your risk consistent. You can't be changing up your risk every single day. You can't say, well, today I'm going to risk 1%, tomorrow I'm going to risk 3%, the next day I'm going to risk 5%, because then you're going to be all over the place. Your reward or your profit isn't going to match up. Your losses aren't going to match up. Keep it as consistent as you can, right? I'm always, for the most part, risking around 1 to 3%. I never really go above that risk ever, right? That's what I like to risk per day. Now, it depends on what you like to risk. You can risk different amounts. It's completely up to you. But I like to target higher RR trades. That's typically what I do, at least 1 to 2 plus. But that's really important, right? So let's just kind of talk about, I'm going to go try to find a different entry model, that we can look. So let's actually look at this most recent entry that I called out this morning that some of you guys did take, right? So we have the GUI model, right? We are delivering from a 15-minute fair value gap after sweeping internal liquidity. So this is still, to me, not a complete A plus setup because this is only a 15-minute fair value gap. We are not delivering from an hourly or a 4-hour or anything like that. But I would still consider this maybe an A setup here, just not A plus, right? So we come up, we soup internal highs here, okay? And then we create a 1-minute bullish fair value gap, right? Boom. 1 minute busy. Notice right when we close below, this becomes an IFEG. So now we've inversed the 1 minute busy. And what does that mean for us? That just means that now bearish order flow has taken control. We're not respecting our bullish levels. We're expecting price to continue lower because of that, right? Because we're, first of all, delivering from a fair value gap. We swept liquidity. Now we have the inversion. Boom. So right when price retraces into that IFEG, that's where we're getting our entry. And where are we keeping our stop loss? Above the wick of the fair value gap candle. Well, this was our fair value gap candle before. This is our IFEG. So now I keep my stop above that level. Now let's say you wanted to maybe give it a little bit more room because you just want to give it more room, right? You want to play it safe. You could keep your stop above the swing high up here, right? I'm typically not going to do that because if price runs all the way back up to this swing high, that means we're probably not going to be seeing price deliver to sell side. So I usually keep it above the wick just like that. And I have found in my trading that keeping our stop losses above or below the wick of the fair value gap candle tends to be the best possible spot. And then what are we doing for TP? We're targeting sell side liquidity. We have a swing low down here. That's a very good first TP. So we're going to put first TP right here. Boom. And then, we're looking for our next sell side right here. This is a good second TP. Let's say you're scaling in with 10 micros. This is going to be second TP. So let's say right here, first TP. You scale in with 10 micros. Boom. We hit this low. I need to turn off the magnet. Okay, so we hit this low. 220 ticks, right? That's giving us over a 1 to 2 RR. That's giving us a 2.6 RR right there. Perfect. I'm selling 5 micros right there. Okay, I'm selling half my position. My stop loss goes to break even. Now it's completely risk-free. I'm securing profit on this trade. Okay, next TP. Boom, right here. 301 ticks. I'm probably selling 3 micros here. So now I've sold 8 micros out of my 10 micro position, and I'm holding down for full TP, which will probably be down at our opening range low down here. Kind of that liquidity. That's probably where I would have taken full TP. Right there is going to be full TP. And that's where I'm selling my last 2 micros on that trade. Oops. So yeah, this is where I'd sell my last 2 micros. And boom, I'm out for 567 ticks. And I call it, that's it. That's all I need, right? That's how I handle a trade like that. On a GUI model, I'm always going to more than likely keep my stop right above the wick of that IFEG candle. And then I'm looking to take TP at our internal lows for a bearish example. And again, once we got down here, this is where we bounced because we're expecting a range day. I was not expecting a full breakout to sell side this morning. So I wouldn't really look to keep trailing my runners here because I'm not expecting price to run. I'm not expecting price to continue down to more sell side liquidity. Even though, we ended up running a little bit more later on, that's just not really what I'd expect on a range day. So on a range day, I'm looking to take my profit, walk away. If we have an expansion day and we had red folder news come out and we're really selling off, then that's when I'd probably hold a few runners. Maybe I would sell a few, maybe one here and leave one runner until we hit this liquidity down here, right? Until we hit external liquidity. But that is how I handle these trades. That's where I like to keep my stop loss. And that's why, how I like to take my TPs for a precision entry. Okay, so we're going to go back to this first page. Remember, if you haven't downloaded it yet, please download that precision entry framework. Yes, I am recording this for you guys. I will post this on YouTube after, so you guys can go back and rewatch it. Okay, so we're going to go through this one last time before we end the session. 3-step confluence checklist for precision entries. Step number 1, higher time frame market structure and bias. Delivery from higher time frame fair value gaps on the 1 hour, the 4 hour, the daily, the weekly. Or order blocks on the 1 hour, the 4 hour, the daily, the weekly. That's going to give us our overall market structure. Okay, and then we're looking for key liquidity, external liquidity. The hourly, the 4 hour, the daily, the weekly. That's external, okay? Where is price targeting? Previous day highs, lows. Previous week highs and lows. Asia highs and lows. London highs and lows. Right? 4 hour highs and lows. We're looking for good market structure. Where is price targeting? And then we're making sure that we have key entry zones, right? High probability fair value gaps, order blocks, liquidity zones. We're looking for those internal sweeps of liquidity. and points of interest, okay? During the macros, for the most part, is when we want to trade. And then step number 3, lower time frame confirmation, drop down to the 1 minute, the 5 minute. That's where we're looking for our refined entries in line with our higher time frame bias, right? And then that's when we go down to the here, and that's when we're looking for our actual entry models, okay? So that is how you find a precise entry in the market. And you should have this list in front of you every single morning. If you cannot check the boxes, if you can't check all of these off the list, you should not be in a trade. There's no point in taking a trade because it's probably going to be lower probability, okay? And that's the reason I didn't take any trades today, because we were not delivering from any higher time frame fair value gaps. I really thought about taking this trade because it was a 15 minute. That's the the lowest I would go in terms of taking a trade without an hourly or a higher time frame fair value gap. But again, write that list down. Have it printed out in front of you. Have it on a PDF form. Go through the checklist every single time you're looking to take a trade. Before you take that trade, check off every box. Say, okay, we are delivering from a 4-hour bullish fair value gap. We have swept internal liquidity while we went into that fair value gap. I have an entry model now because we have a bullish GUI model. We got an IFVG. Now I'm taking my entry. I'm good to go. I have full conviction. I don't need to jump out of the trade the second it goes into the red, because now I understand that I am confident in my strategy. I have conviction in this trade, and I can let it play out until it either hits TP or hits my stop loss, right? If it hits my stop loss, I understood the risk. That is the risk of trading. Not every trade is going to work out, but at least I know that when I hit that stop loss, I took a precise entry with a high probability setup, okay? That's what it's all about.